Today, we will talk about something that can be a bit confusing for both experienced and new traders: gaps on Forex charts. Welcome back to our channel. Please subscribe so that you will not miss our future videos. Also see the links in the description box below if you also want to download free Forex robots, indicators, courses, and books. Getting back to the subject of our video, gaps are a common occurrence in the foreign exchange market. And I know that when I first started trading, I didn't really understand what they were or how to trade them. So in this video, we will break down what gaps are, how they form, and give you some tips on how to trade them. By the end of this video, you'll have a better understanding of gaps and how to use them to your advantage. First things first, let's define what gaps are. A gap is a break in the normal price pattern on a chart. It occurs when the price of a currency pair jumps from one level to another without any trading taking place in between. In other words, there is a gap in the data. These gaps can happen on any time frame, but they're most commonly seen on the daily chart. I'm sure you've seen them before. You'll notice a big empty space between two candles on the chart. That's a gap. Now, you might be wondering why gaps happen. Well, there are a few different reasons. One of the most common causes is a sudden change in market sentiment. For example, a positive economic report may cause investors to buy a currency, pushing its price higher and creating a gap. Or, on the other hand, a negative economic report may cause investors to sell, pushing the price lower and creating a gap. Another cause could be a major news event such as a natural disaster or political crisis, which can cause a gap to form as traders react to the news. Gaps are also a common occurrence on charts when the market reopens for a new week after the weekend break. Okay, so now that we know what gaps are and why they happen, let's talk about the different types of gaps. There are two main types of gaps: common gaps and breakaway gaps. Common gaps are those that tend to occur within a trading range and usually don't have much significance. You'll see them all the time, but they're not really something you need to pay too much attention to. Breakaway gaps, on the other hand, occur at the beginning of a new trend and often signal a significant change in the market. These are the ones you want to pay attention to. So now that we know what to look for, let's talk about how to trade gaps. One approach is to wait for a gap to fill, which means that the price will eventually move back to the level where the gap occurred. This can be a profitable strategy if you're able to correctly predict when a gap will fill. But you have to be patient. It can take a while for the gap to fill. Another approach is to trade in the direction of the gap. For example, if a gap occurs to the upside, you may want to buy the currency pair in question. This strategy can be riskier, but it also has the potential for bigger gains. But again, you have to be careful and make sure you're making educated trades. It's important to note that gaps don't always fill and that it can take time for them to do so. Also, trading gaps can be difficult, and it may take some practice before you become proficient at it. In conclusion, gaps are a common occurrence in the foreign exchange market and can be caused by a variety of factors, such as sudden changes in market sentiment or major news events. There are two types of gaps: common gaps and breakaway gaps. Trading gaps can be a profitable strategy if done correctly, but it can also be risky. It's important to practice and gain experience before attempting to trade gaps. I hope this video has helped you understand gaps better and how to use them to your advantage in your trading. Do you trade gaps? Leave your thoughts and comments in the comments section below.